Welcome to this explainer on the brand new interest charging provisions under Chapter 19E of the Income Tax Act 2025. Whether you're a chartered accountant, a tax professional, a CA student, or a business owner, navigating this massive transition from the old 1961 Act to the new 2025 Act is absolutely crucial for your practice and your compliance. Today, we're breaking down exactly what you need to know about how interest on tax defaults is calculated under this entirely new regime.
Picture this. Your client comes to you having missed their tax filing deadline, or maybe they've fallen short on their advance tax. Under the old act, you knew the drill. You knew exactly what sections applied. But in this new regime, the rules of the game have completely changed. So, how do penalties and interest calculations shift under the Income Tax Act 2025 and the new Income Tax Rules 2026?
Here is a quick look at our agenda. We'll introduce Chapter 19XE, break down sections 42 through 42.6, walk through a practical interest calculation, look at compliance traps, and summarize our key takeaways. Let's get right into it.
Section 1. Introduction to Chapter 19E. Okay, let's dive into this and look at how the core terminology itself has fundamentally shifted. Before we can even calculate a single rupee of interest, we have got to understand a monumental shift in our tax vocabulary. As clarified in the recent CBDT transition FAQs, the concept of the assessment year is entirely discontinued in the new 2025 Act. We now use one single reference point, the tax year. This completely aligns the year the income is earned with the year it gets assessed. So what you previously knew as financial year 2026-27, which would have been assessment year 2027-28, is now simply tax year 26-27. It's meant to simplify things, but keeping this shift top of mind is absolutely crucial as we evaluate these new interest sections.
Moving on to Section 2, breaking down sections 423 to 426. Let's unpack the actual mechanics of these new legal provisions. And this brilliantly illustrates the direct mapping from the old law to the new one. Look, if you're a tax professional, the old 234 series is probably permanently etched into your memory, right? Well, it's time for an update. Under the 2025 Act, Section 234A becomes Section 423 for defaults in furnishing returns. Section 234B becomes Section 424 for advanced tax defaults. Section 234C maps directly to Section 425 for deferment of advanced tax. And finally, 234D becomes Section 426, which handles interest on excess refunds. The numbering is completely different, but the fundamental structure is kept intact to ensure continuity for professionals like us.
All right, let's look at the statutory formula laid out in Section 423 for late or missing returns. The Act gives us a very straightforward, simple interest calculation. I equals 1% multiplied by A multiplied by T.
Breaking these components down, I is obviously your interest payable. A represents the tax amount you're actually paying interest on. Basically, your assessed tax minus any advance tax paid, TDS, or applicable tax reliefs. And T, that is the number of months in the period of default. This starts on the day immediately following the due date, right up to the actual date the return is furnished or assessed.
But here's where you have to be incredibly careful with compliance. Under Rule 269 of the Income Tax Rules 2026, when you're calculating interest, any fraction of a month is deemed to be a full month. This means if your client files their return just one single day late, the system is automatically going to calculate T as one full month. There is absolutely no prorating for days. Now, moving beyond Section 423, the rates actually vary depending on the default. For Sections 424 and 425, which deal with advanced tax shortfalls and deferments, the interest rate remains 1% per month, though it can actually jump to 3% for specific deferment periods under Section 425. On the flip side, if the department grants an excess refund to a taxpayer under Section 271 and then later catches that error during regular assessment, Section 426 says the taxpayer has to pay back that excess with a 0.5% simple interest per month. Section 3. Practical tax interest example. Let's shift from the bare act into a real-life application so we can see exactly how this works in practice.
Imagine a business owner who needs to file their return for tax year 2026-27. The due date is July 31st, but they file on August 15th. Step 1, we've got our tax year and our missed deadline. Step 2, because they filed in mid-August, they are 15 days late. But remember Rule 269? That delay T is instantly rounded up to one full month. Step 3, if their outstanding tax liability A was 1 lakh rupees, we apply the 1% statutory rate under Section 423. Step 4, we arrive at the final interest payable, which is 1,000 rupees. The math is simple, but missing that fractional month rounding rule is going to be a very common trap.
Section 4. Compliance and Common Issues. Let's explore the practical roadblocks, particularly those that are going to pop up during this unique transition phase between the two acts.
Now, what's really interesting here is how the e-filing portal differentiates payments during the transition year. As a tax pro, you'll be making payments in the financial year 2026-27 that might relate to the old act or the new act. If a payment relates to FY 2025-26, let's say a delayed self-assessment tax paid in June 2026, you must select assessment year 2026-27 on the portal. That is governed entirely by the old 1961 Act.
Conversely, if you're paying advance tax for the period between April 2026 and March 2027, you must select tax year 2026-27, which puts it under the new ITA 2025. The CBDT FAQs are explicitly warning us that making incorrect drop-down selections here will lead to system-level validation errors. Worse, it could trigger completely unwarranted interest under Sections 423 to 425 simply because the system won't properly match your payment to the correct legislative framework.
Section 5. Summary and Key Takeaways. Let's pull all of this together into some actionable items you can take back to your desk.
So the absolutely crucial takeaways are these. First, tax year is your new operating timeline. It completely replaces assessment year. Second, whenever you think of the old 234 series penalties, immediately translate those to sections 423 through 426. Third, do not forget Rule 269 of the Income Tax Rules 2026. Any fraction of a month late equals a full month's interest. Fourth, navigate the transition year portal selections with extreme care to avoid systemic headaches. And finally, accurate referencing of these new sections is simply non-negotiable.
As you update your firm's processes for the 2025 Act, you really need to ask yourself, is your compliance software actually ready to handle the new single tax year without triggering automated penalties? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.